Hey tax enthusiasts, get ready for a tax tale that will raise eyebrows and spark some serious reflection. Just imagine, you're at the beginning of tax season, sitting across from your tax practitioner, a seasoned professional we'll call Mike. The engagement letter is signed, everything seems routine, and just when you think it's business as usual, you drop a bombshell. You admit to Mike that you've been playing a cat and mouse game with the IRS for years, cleverly hiding income and maybe stretching the truth on deductions. Now, you've got Mike in a real tax pickle. He knows your actions are on the wrong side of the law, and he's faced with a dilemma. Should he turn you into the IRS and potentially collect a whistleblower reward? It's a situation ripe with ethical questions. In today's video, we're delving deep into this complex scenario. Can Mike actually blow the whistle on you? And perhaps more importantly, should he? We're exploring the legal and ethical dimensions of this tax dilemma that's got everyone talking. Let's break down the nitty-gritty. So, you spill the beans to Mike about your tax shenanigans, thinking you're in the clear. Surprise! Mike can actually report you to the IRS no matter how tight you think you are with him. The IRS has this Form 211 where CPAs and lawyers like our buddy Mike can spill the tea on non-compliant taxpayers. And guess what? If your tax mischief leads to the IRS grabbing extra cash in taxes, penalties, and interest, Mike might just get a piece of that action as a reward. But hold on, it's not a straightforward decision for Mike. He's got ethical hoops to jump through. First off, he's got to talk to you, advise you on getting onto the straight and narrow. Plus, there's this confidentiality thing. Mike can't just blab about your tax escapades without your nod or a legal push. Now, there are some exceptions to the secrecy rule. If Mike's got a subpoena or a court order, or if he's playing by the laws and regulations, he might spill the beans, but just chasing that whistleblower award, not so fast. In a nutshell, Mike's got your back to an extent, but he's got rules to follow. So the next time you think about bending those tax rules, remember, Mike might have to make a tough call. Stay legit, folks. Now let's talk about what's going on in Mike's head. He's got a bunch of things to weigh. It's not just about numbers and deductions. First up, there are these ethical responsibilities hanging over Mike's head. The American Institute of Certified Public Accountants, AICPA, has these rules that CPAs like Mike need to stick to. State boards of accountancy have their own codes too. If Mike is part of the National Association of Enrolled Agents, NAEA, they've got their own ethical code. Now, these codes are like the rule book for tax pros. They're big on confidentiality, but they also say Mike has a duty to the public interest. So, if you think you're up to some fishy business that could mess with the whole tax system, he's got an ethical duty to spill the beans, especially if it involves his accounting services. There's a moral compass in play here. So, when you're pushing the tax boundaries, remember, Mike's got ethics on speed dial. It's not just about dollars and cents, it's about doing what's right. Now dive into the not-so-fun world of tax evasion. This is no small deal. It's a purposeful, calculated move by individuals or entities to dodge paying their taxes. We're not talking about honest mistakes here. Tax evasion is a deliberate act. And guess what? It's not just a slap on the wrist, it's a felony. Those caught in the act face some serious consequences. Not only are they on the hook for the unpaid taxes, but they could also be staring down official charges that might lead to some time behind bars. The IRS doesn't mess around with tax evasion. Individuals caught in this web might be looking up to 5 years in jail, fines reaching a hefty $250,000 or even both. Now if we're talking corporations, brace yourself. The fine can skyrocket to a jaw-dropping $500,000. And if the evader made some economic gains from their shady practices, the government can swoop in and collect double that amount. What's considered tax evasion, you ask? Think deliberately underreporting or omitting income, claiming false deductions, keeping not one but two sets of books, making up entries in records, claiming personal expenses as business expenses, and dancing with the dark arts of abusive tax schemes while using multiple pass-through entities to hide taxable income. All in all, tax evasion is a serious offense with some hefty consequences. Now, here's where Mike's incentives kick in. If he decides to spill the beans and provides the IRS with the inside scoop that leads to a successful audit and the recovery of those unpaid taxes, there's a payday waiting for him. The IRS is not stingy when it comes to rewarding whistleblowers like Mike. He can bag a sweet 15 to 30% cut of the collected proceeds. But there's a catch. It's only if certain conditions are met. If the IRS takes the info but doesn't manage to collect a dime, Mike's left empty-handed. Now, let's talk big numbers. If the amounts in dispute are $2 million or less, the IRS caps Mike's reward at 15% of the recovery. But if we're talking big bucks, anything over $2 million, Mike looking at a payday between 15 and 30% of the amount collected. Talking about paperwork. If Mike decides to kick off the federal whistleblowing process, he'll be filling out the IRS Form 211. Surprisingly, for an IRS form, it seems like a walk in the park. Mike might get a bit of follow-up mail from the IRS, but for the most part, they'll take the reins on the investigation without needing Mike to play detective. Here's the catch. Mike's Form 211 needs to spill the beans in a specific, credible, and brand new way. If it's too vague, not related to taxes, or the IRS already has the lowdown, Mike's looking at no payday. Now, Mike can't be the puppet master behind the tax evasion plot. If he is, the IRS, by the rules, can slash his award anywhere between 67 and 100%. It's like you can't play both sides situation. Now, here's where it gets interesting. Mike doesn't need a halo to join the whistleblower program. Take Bradley Birkenfield, for example. He spilled the beans on Swiss bank UBS back in 2007. Despite being in the thick of helping wealthy Americans hide their assets and dodge US taxes, he walked away with a mind-boggling reward of $104 million through the IRS whistleblower program. So Mike might not be a saint, but if he's got the goods and plays by the rules, he could be looking at a nice little reward. Whistleblowing, it's like being the hero in a tax-themed detective story. Keep those forms handy, folks. In conclusion, the journey of reporting to clients for tax evasion, as undertaken by professionals like Mike, is a nuanced and ethically charged endeavor, balancing the imperative of upholding the tax system's integrity with the commitment to client confidentiality presents complex challenges. Professional codes from organizations such as AICPA and NAEA underscore the importance of confidentiality and acting in the public interest. When client activities veer into tax fraud territory, practitioners like Mike face a moral crossroads. The IRS Whistleblower Reward Program introduces a compelling incentive of 15 to 30% for reporting tax evasion. This dynamic, exemplified by Bradley Birkenfield's substantial reward despite involvement in illegal activities, brings forth ethical complexities for tax professionals. In this whole narrative, tax practitioners navigate a train that extends beyond mere numbers and forms. The tale of challenges and choices prompts contemplation on the ethical conduct within the intricate world of tax professionals. As we conclude, stay tuned for further exploration into the labyrinth of ethics and incentives inherent in tax evasion reporting.